In this video, we will be working through problem 717 in the book, and it will be a comprehensive problem that deals with activity-based costing. So let's go to the book online, or you can turn to it in your hard copy. So it says comparing traditional and activity-based product margins. So this problem is going to illustrate how activity-based costing will assign a different cost to the products than the traditional absorption costing method. And if different cost is assigned to the products than under one method versus another, that means the profit that each product that you get from selling each product under one method is going to be different than under the other, and that could make a difference. And how you assign the costs, that's the major difference between activity-based costing and absorption costing. Absorption costing, if you remember from lecture, assigns costs based on one activity or one cost driver that is really related to volume. So number of units, number of labor hours, something like that. In terms of the overhead costs, right? The stuff that's directly traced is easy. That stuff is just directly traced to the products, but the indirect costs that are still product costs that need to be allocated or assigned to the products under absorption costing, they are assigned to the products using one volume-based cost driver, and under activity-based costing, those indirect costs are assigned to the products using multiple cost drivers based on the activities that those products, in making those products that you consume resources in. So we have this company here, Precision Manufacturing, and they make two types of industrial component parts, the EX300 and the TX500. And there's an income statement for the most recent period using the traditional method of costing, absorption costing. So you can see they have a $50,000 loss as a whole. Now the question is, which of these products is causing them to lose money, or are both of them causing them to lose money? But you can't tell that using absorption costing, right? You see the $50,000 loss, but you don't know if they lose money because are they losing money on the E product or the T product, or both? Maybe they're losing money on both. So it says that they produced and sold 60,000 units of the E product at a price of $20 per unit, and 12,500 units of the T product at a price of $40 a unit. So their biggest seller obviously is the EX300, and it's priced cheaper. Now the company's traditional cost system allocates manufacturing overhead to products based on a plant-wide overhead rate, and they use direct labor dollars as the allocation base. Additional information relating to the company's two product lines is shown below. And you can see the direct materials cost for the companies here, and here's how much was traced to each of the products respectively. The direct labor total cost was here. Here's how much of the direct labor was traced respectively to each of the two products. And then all the other product costs that are indirect would be manufacturing overhead. So you can see the total cost of goods sold there, $1.2 million. And that jives with this right up here in the income statement. Now, it says the company has created an ABC system to evaluate the profitability of its products. The company's ABC implementation team concluded that 50,000 and 100,000 of the company's advertising expenses could be directly traced to the E and the T product respectively. So now we know that not only are direct materials and direct labor traced to the E and T respectively, but also the advertising expenses, which before was just lumped in here. No, it wasn't lumped in there. Advertising would just be lumped in this SG&A stuff right here, this 550,000. Now we know 50,000 of this 550,000 for advertising for the E product could be directly traced to that product, and then 100,000 of the 550 could be directly traced to the T product. So now our direct costs under ABC are going to be the direct materials, direct labor, and the advertising. And what else does it say here? The remainder of the SG&A expenses were organization sustaining in nature. The ABC team also distributed the company's manufacturing overhead to 4 activities as shown below. And here are the activities that the overhead was distributed. So here's their manufacturing overhead, and In order to allocate this overhead to the products, they have these 4 activities: machining, and the driver for that activity is machine hours; setups, and the driver for that activity would be setup hours; product sustaining, and the driver of that activity would be number of products; and then other. These are organization sustaining costs. They don't have a cost driver. They're just other manufacturing overhead costs that don't fall into one of these 3 activities above. So as you can see here, they were able to now we've already gone through the first 3 steps of ABC, or the first 2 steps. This problem's already done that for you, and it hasn't told you how it did it, but $198,250 of the total manufacturing overhead was for machining. And how do we know that? Well, it just gives that to you. In a company, if you're actually doing this, you would have to figure out how much of the overhead should be assigned to each of the activities. And you do that through employee interviews. And you have to go look out across your company and go figure out how much each activity costs the company. It varies depending on what the activity is, the process. Obviously, if it's machining, I'm trying to think, how would you do that here? You can't interview the machines, but yeah, you could figure out the people that work on these machines. No, I'm trying to think here. Maybe you wouldn't be able to do that for this one. We already have our direct labor cost. That's up here. But machining, you could get an estimate of this total overhead cost. How much of it is because of the machining activity? You could figure out how much time the people spend on the machines, making these E and T products. Somebody's got to operate the machine, and you could ask them how much time they're spending versus how much time people are spending setting up the machines. So yeah, you could do employee interviews here, and you could get at a weight between 0 and 1. How much of this total overhead, 508,625, should go to the machining activity? If all the people that are involved in making this product spend, 30% of their time on machines, then maybe 30% of this should go to the machining activity. So yeah, you could do employee interviews there. But anyway, they already do that for us, and here we have it broken down, and we actually have it broken down. The cost driver. So for example, the EX300 took 90,000 machine hours, and the TX500 took 62,500 machine hours. The total machine hours is here. How many times they have to set up the machines for the E product? 75 times. How many times for the T product? 300 times. There's the total setups. And then there's 1 E product, 1 T product, and there's 2 total products. And the other activity, the organization sustaining stuff, it's just all that other stuff. And there's no cost driver for it. So it's just everything else. So what do we need to do here? We need to compute the product margins for the E and the T product under the company's traditional costing system. The first thing I want to do before we even do anything, before we even do number 1, I want to draw a diagram that will help you, hopefully in your mind, figure out exactly what ABC is doing, how it's assigning costs and allocating costs. So in this particular example here, we have our direct materials, we have our direct labor, we have our advertising, and we have our overhead. And I'm going to put boxes around these guys. Now, battery charge. Am I low on battery? No, I'm plugged in. Alright, so the direct materials in this problem were what? 528875. These are directly traced to the cost objects. So down here we're going to have our cost objects, which in this case are the products. Remember, a cost object is anything that the company desires cost information about. So we are going to have our direct materials, which are traced. I should do that. And so trace directly. We have our direct labor that's traced directly. And I don't want to do that here. Let's take that off. There we go. We have our direct labor that's traced directly. So do it like this. Whoops. It's a little messy. We have our advertising. And that's also traced directly. Under absorption costing, under the traditional method, remember, advertising is just a SG&A. It's a selling general administrative expense. But they've figured out that they can actually directly trace $50,000 of the advertising to the e-product. They spend $50,000 in advertising for the e-product during the year. So why not directly trace it to the products, to the cost objects? And then the $100,000 they could directly trace to the T product. So why not do that? So ABC attempts to more accurately trace and allocate costs. That's the idea. That's the purpose. It attempts to more accurately trace cost to products or to cost objects. All right. So overhead. In here, so direct labor was 162,500, and advertising is 150,000 total. Where did it tell us that? Well, if you go back here, there's the direct labor, 162,500, and it said advertising right here, 150,000. Now that means that the overhead must be 908,625, and we're going to show you why that's true. Put a star by that. Let's go get that. How do we get that number? Well, that would be the manufacturing overhead plus the non-manufacturing overhead. Whoops. What's non-manufacturing overhead? Another name for that is SG&A. So the non-manufacturing overhead minus the advertising, since we already took the advertising out of that. So it's the manufacturing overhead, 508,625, I believe. If we go back, what was it? Yeah, 508,625 right here, right down here. And then we add the non-manufacturing overhead, which is SG&A, 550,000. How do we know that? Go to the income statement and look at SG&A, 550. But 150 of that was advertising. Right? So that equals 908,625. Now, this stuff is allocated to the products under ABC. So, well, sorry, most of it's allocated. That stuff that's just organization sustaining in nature is not allocated. That's the only stuff. Whereas under the absorption system, the stuff that's not allocated to the products is all the SG&A stuff, which is a lot of stuff that's not allocated. It's just directly or expensed immediately in the period incurred. But under ABC, a smaller portion of that other stuff, of that non-manufacturing overhead, or that SG&A if you want to call it that, a smaller portion of that remains unallocated at the end, but you allocate more stuff under ABC to the products, or to the cost objects. Now, this 908,625. We allocate using the activities. So machining, setups, and product sustaining. The cost of these activities are allocated to the cost objects. If you want to, maybe I should just do it like this. The cost objects here are the EX300 and the TX500, right? The two products. And then this last little arrow here, this organization sustaining stuff. Stuff that's just organization sustaining in nature. That remains unallocated. So, how much of that stuff is unallocated? Well, if we go back here and look, all of this is allocated. It's manufacturing overhead. And then we know 150,000 of the 550 of the SG&A is directly traced. So that leaves what, 400,000 of this that's unallocated, along with this 60,375 that's unallocated. So 463.75 would be the unallocated portion. The 400,000 SG&A plus the 63.75 of the so 400,000 of the non-manufacturing overhead is unallocated, and 60,375 of the manufacturing overhead is unallocated. This is the stuff that's unallocated. If you want to call, that's just the expense immediately in the period incurred. So in this question, I could ask, what costs are expensed immediately in the period in which they are incurred, or I could say which costs are sort of expenses under ABC. And you would say 463.75. And under absorption costing, which costs are expenses? And you would say, if it was under absorption costing, the expense costs are just the SG&A. So you can see that there. There's the difference. So we allocate more under under ABC than we do under absorption. Why? How do we know that? Because less costs. There's less things that are just expensed immediately. Versus absorption or traditional system, we have more things that are expensed immediately in the period incurred. In other words, more things that are unallocated. So hopefully this makes sense to you guys by looking at this little diagram here. Now let's go ahead and do what they wanted us to do. First, part 1. What does it want us here? It says compute the product margins for the EX and TX under the company's traditional costing system. Okay, let's do that. So remember, the product margin would be the sales less the total product costs. So the sales revenue less, under the traditional system, it'd be sales revenue less the cost of goods sold. The product costs under the traditional system are just the cost of goods sold. So direct materials, direct labor, and that portion of manufacturing overhead, where overhead is assigned using that one cost driver that they told us about. And what was the cost driver? I believe it was direct labor dollars was the thing they thought drove the manufacturing overhead costs, drove the incurrence of overhead. So total sales is 1.7 million. Just for how do we know that? Well, it told us that, right here. How much was for the E product? Well, they sold 60,000 units at a price of $20 per unit. So you can do the multiplication there. So 1.2 million to the E product. And then the other 500,000 must be going to the T product. And we can check to make sure that's right. They sold 12,500 units of the T product at $40 a unit. 12,500 times 40 is 500,000. And then direct materials, total direct materials is 528, 875. It told us that right here. How much of it goes to the E product? 366, 325. How much to the T product? 162, 550. And then for the direct labor, we know that as well down here. So I'm just copying this stuff from the information they gave us. And then direct labor total was 162, 500. How much goes to the E? 120,000. How much goes to the T? 42,500. And now manufacturing overhead. We know the total was 508, 625. How much goes to the E product? 375, 600, and I'll show you how I got that. And then how much to the T product? 133, 025. So I'll put a little superscript A here and a superscript B, and I'll go down here and show you how I calculated. A would be how much goes to the E product. Remember, what drives overhead under the traditional system? There's one cost driver, and in this case it's direct labor dollars, I believe, if you look here. The company's traditional cost system allocates the manufacturing overhead to products using a plant-wide overhead rate, and direct labor dollars is the allocation base. Or in other words, direct labor dollars is the cost driver. So how many ever direct labor dollars were spent on the E product, that's what they use to assign the overhead to the E product. Right? So first we figure out the predetermined overhead rate. And that would be the total overhead divided by the total level of the cost driver. What's the cost driver? Labor dollars. What's the total labor dollars? 162, 500. So we divide that and we see that the overhead rate is 3.13. I don't know why I have dollars here. It's because the dollars cancel. It's unitless. It's 3.13. For every dollar we spend on direct labor, we expect that to lead to $3.13 of manufacturing overhead. So it's a 3.13 to 1 ratio. And then to figure out, so maybe this should just be right up here. Actually, that can be like that, and then we put A underneath it. Do it like this. So you have to calculate the POHR first, and once you have it, how many direct labor dollars were spent on the E product? 120,000. And what's the overhead rate? Times 3.13. For every dollar we spend on direct labor, we expect $3.13 of overhead. So if we spend $120,000 on direct labor for the E product, then we expect, if you do the multiplication there, we expect $375, $600 of manufacturing overhead related to the E product, right here. And then in B, same thing. What's the cost driver for the T product? 42,500. We spent that much for direct labor for the T product. Times the predetermined overhead rate, and you get the 42,500. So we've assigned overhead to both products, and those are the total product cost under the traditional system. Direct materials, direct labor, and manufacturing overhead, or cost of goods sold if you want to think of it like that. So the total product costs would be, well, in total 1.2 million. That's the total cost of goods sold, and that jives with what they told us right here. If you add those numbers up there, you get 1.2 million, these three numbers. And then for the E product, it is 861,925, and for the T product, it's 338,075. I'm just adding these three numbers. And then our product margin then would be calculated by taking total sales for the product minus the costs, the product costs. So the total product margin is 500,000, and then the total that'd be the gross margin or the gross product, and then the product margin for the E product is a 1.2 million minus 861,925, 338,075. And for the T product, it's 500,000 minus 338,075. And these just happen to be the same. That's a coincidence. It's an unfortunate coincidence because it might confuse you, but those two numbers just happen to be the same. It's just a coincidence, though. So 500 minus 338,075 would be 161,925. And now you see something that, you see the problem with traditional system, right? How could the product margin for both products, how could they be making money on both products, but have a net loss for the company? And we can see the reason, right? All we've subtracted here are the product costs, but there's $550,000 of SG&A that we got to subtract from this $500,000 total gross margin to give us our $50,000 loss, right? So it's the way we're leaving these $550,000 of costs that we're expensing immediately that remain unallocated. That's causing the problem. That's making these product margins distorted, making it look like we're making money on both products but having a loss overall. And ABC will come in and take some of this $550 and actually allocate it to the products. But it won't just do that. It actually allocates differently the stuff that it doesn't just allocate what traditional system does and then allocate some extra stuff. No, it not only allocates extra stuff, but it takes the way that it allocates stuff is different than the traditional system as well. So there's several sources of differences between the two. So let's get rid of this here. All right. So we completed part 1. There's the answer for the E product and the T product. Product margin under traditional system. All right, let's go and do part 2. What do they want here? Compute the product margin for the E and the T under the ABC system. All right. Let's do that. Under ABC, we'll start with sales, like we do. We have a total. We have a column for the E product, a column for the T product. We know the sales total was 1.7 million. We know the E got 1.2 million of that, and we know the T got 500,000 of it. Now costs. ABC treats costs a little differently. I'm not going to say cost of goods sold here because I want to just make a distinction between ABC and traditional system. We have our direct materials, our direct labor, and our advertising. And then, let's be clear here. All these costs I'm going to list are product costs, but they're product costs under the ABC system. All these costs here are product costs, but they're product costs under the traditional system. Product costs under the traditional system are different than product costs under the ABC system. There are some costs the traditional system does not call product costs that ABC does, and vice versa. There are some costs that traditional system does call product costs that ABC doesn't. Let's give an example of the first one I just said. What are some costs that traditional system does not call product costs, but ABC does call them product costs? Advertising, for example. The traditional system calls that a period expense, but ABC calls it a product cost, right here. Now, what's an example of a cost that under the traditional system, it is a product cost, but under ABC it's not? Well, look, under the traditional system, all of the manufacturing overhead is a product cost. But according to the way we've allocated here, under ABC, 60,375 of this manufacturing overhead is going to remain unallocated because it's just organization sustaining in nature. The costs are just to keep the organization sustaining as an organization. They're not really for any of these products. Whether we have the products or not, we're still going to have the costs, like the rent for the factory, for example. Or maybe that's a bad example. Maybe paving the road outside. That would be an example of an organization sustaining manufacturing overhead cost. So there's a cost right there that under the traditional system is called a product cost, but under ABC is not. So anyway, let's keep going here. Let's go. All right, so we have our under ABC, the product costs would be the direct materials, direct labor, because it's directly traced, advertising because it's directly traced, and then the cost of overhead broken down by the 3 activities: machining, setups, and product sustaining. And these are the direct costs, and these are the indirect costs. And let's move this over a little bit. We don't want that to get in the way. Alright, our direct materials, same thing, 528,875. And then we know 366,325 for E, 162,550 for T. It gave us all this. Direct labor, we know the total was 162,500, and 120 went to E, and 42,500 went to T. Then advertising, it told us the total was 150,000. It said we could trace 50,000 of that to the E and 100,000 of it to the T. It told us that in the setup there. We read that already. And then machining, what's the cost of the machining activity? Well, let's look here. Go back. Machining total cost was 198,250. How much goes to the E and how much goes to the T? We can't figure that out until we figure out the activity rate for the machining activity. So we'll do that in a sec. What's the total cost of the setups activity? 150,000. And then what's the total cost of the product sustaining activity? 100,000. Now, how much goes to E and T for each of these three activities? Well, we need to go down and calculate the activity rates to figure that out. So I'll label this little c, this will be little d, little e, little f, little g, little h. So, machining, what's the activity rate for machining? What drives the cost of the machining activity? Machine hours. That's the activity driver. How many machine hours total were there? 152,500. What's the total cost of the activity? 198,250. The activity rate for an activity is the total cost of the activity divided by the total level of the cost driver for that activity. So 198,250 over 152,500. $198,250 over 152,500 machine hours, and we get an activity rate of $1.30 per machine hour. Now, how many machine hours were used for the E product? 90,000. So 90,000, and each machine hour costs $1.30. 90,000 times $1.30 equals this right here, equals C. Make sense? Hopefully that does. So let's finish setups. Total cost is 150,000. Total cost driver. How many setups would they do? How many setup hours? What is the cost driver? It's setup hours. How many setup hours were there? 375. Oh, so we're gonna see here that setups is a pretty expensive activity here. $400 per setup. Very costly. It's a rather costly activity. And it's something that the traditional system would not recognize. What's going to happen here is it's going to turn out that since we do so many more setups for the T activity, the T product, for this activity, the T product is rather costly, and the traditional system just treats both products as being equally costly for this activity because it doesn't consider this activity. So it's implicitly assuming that both products are equally costly for the setups activity. Implicitly assumes that because it's not considering, it's not treating, it's not even recognizing this activity. When in fact, no, both products are not equally costly for the setups activity. The T product is much more costly, and we'll see that here in a second. Product sustaining. Alright, we have total cost of the activity, 100,000. What drives product sustaining activity? I think it's just number of products, and there are 2 of them. So each one's going to get 50,000. And yeah, now we can go ahead. So little c would just be the activity rate times 90,000 machine hours for the E product. Little d would be the activity rate. How many hours were used for the T product? Let's see, machine hours, 62,500 you see right here. So you can fill in here. So this is 117,000, and this is 81,250, Now let's go down to setups. So little e, what's the rate? It's $400 a setup. How many setups for the E product? I believe it's 75. Yeah, right here, 75. So the E product should get how much cost for that activity? It would get 400 times 75, which is 30,000. The T product would get 400 times 300, which is 120,000. So there's 300 setups for the T product right here. Now, I should quickly point out, if the activities here are equal, like if each product uses the same amount of the cost driver for each activity, then both the ABC and the absorption costing, traditional costing system, we're going to give similar results for the product margins. The only difference then would be the fact that ABC called $150,000 of advertising a direct cost. That would be the only difference then under ABC and traditional. In this example, if these numbers were always equal to each other, if they were split equally among the products. But to the extent that each product does not consume the same resources of each activity, that's the extent to which the ABC system product margin and the absorption system product margin is going to differ. Or you could also say that's the extent to which the traditional system is incorrect in its assigning of costs. So let's see, and then little g would be 50,000, and then here's 50,000. Right? So now we can have our total product costs. I should probably just label this product cost instead of costs, because there are some other costs that aren't sitting here. Right? There's the 400,000 of SG&A that was not allocated, and there's the 60,375 of overhead right here that's not allocated under the ABC system. So total product cost here is 1,289,625. Right? If you add up these numbers. And then total costs for the E product is 733,325. And then over here it's 556,300. And now product margin, which is what they were asking us to find for each product. Take the sales. So E product sales 1.2 million minus the costs, and you get 466,675 for the E. And then for the T, 500,000 minus the 556,300, you get the negative 56,300 product margin for the T product. So it looks like we're losing money on the T product, and we're actually making money on the E product. What happened here? Looks like that the traditional system overcosted the E product, gave it too much cost right here, 861 versus 733, and therefore it reported that the E product had a lower product margin than it really did, and it undercosted the T product that only gave it 338,075 when it should have gotten 556,300, and therefore it reported that the T product had a higher product margin than it really did. And so in part 3, they want us to kind of describe this a little better here. It says, prepare a quantitative comparison of the traditional and the ABC cost assignments. Explain why they differ. Well, I've already explained it in words, but one way we can do this here is if we just can actually see it maybe a little clearer here. Traditional cost system. If you just want to call it absorption costing, that's fine. Have a column for that. I've got X300, TX500. Running out of room. We need a total column as well over here. Alright. Let's do it like this. Direct materials, direct labor. Here's all the costs under the traditional system. Total costs. All of them. DM, DL, manufacturing overhead, and I'll put a star, and total product cost would be the sum of those. And then we have left the SG&A stuff. So DM would be 366,325 for the E product, and for the T 162,500, and the total would be 528,875. They gave us this. Now what I want to do is I want to express each the cost for each product as a percentage of the total cost for that line item. So 366,325 divided by 528,875, that represents 69% of the total direct materials cost goes to the E product, which leaves what, 31% for the T product. And then for labor, 120,000 goes to E, and I believe it was 42,500 to the T. Total was 162,500. So 74% goes to E, and 26% goes to T. Now for manufacturing overhead, we know the total was 508,625, and we figured out that 375,600 goes to E under the traditional system, and 133,025 goes to T under the traditional system. So 74% of the manufacturing overhead is going to the E product under the traditional system, and 26% is going to the T product under the traditional system. The total product cost here is 861,925 for the E, and 338,025 for the T, and then a total 1.2 million. And then SG&A then is just subtracted from the 1.2 million. It was 550,000, and it gave us our $50,000. Whoops, sorry. And we're just talking about costs here. So our total cost for 1,750 under traditional system. Total costs under traditional versus total costs under absorption is going to be the same total cost number, just the way in which they're allocated is different. Pay careful attention to this right here. Now under ABC, let's do the same thing under ABC. So ABC, we're going to have our E, a T, a total, and we're going to have our direct costs, DM, DL, advertising, our indirect costs, which is called overhead under ABC, but it's not. It includes some manufacturing, some non-manufacturing stuff. It's broken down: machining, setups, alright, maybe I said it wrong. It's called overhead, and it includes any costs related to these activities, which is usually manufacturing overhead, sorry. So then the total costs, total product cost under ABC, and then we're going to have stuff costs not assigned or not allocated to products left over here. Alright. Oops. And then, yeah, and then total cost. Alright, direct materials, we know for E was 366,325, and that represented 69% of the total. TX was 162,500, and that represents 31% of the total. The total was 528,875. I'm just copying from before. 120 here, 42,500 here. That's 162,500. This is what, 74%. This is 26%. Advertising advertising E got 50,000 of it, and it's got 100,000. So this is 33%. This is 67%. Total is 150,000. And then now machining. 190. Wait. No, that's fine. All right. So machining for the E was what? 117. We figured out. And for the T, it was 81,250. If you go back, we've done this already, right up here, right? 117, 81,250, 30, 120, 50, 50. So 30 setups for the E product. The E product got 30,000 of the activity costs for setups. The T product got 120,000. So percentage-wise, this is 150. This got a fifth. E product did, and the T product got 80% of it. And then up here it's 117. Let's see. This is 59%, and this is 41%, and the total was 198,250. Product sustaining. This is 50, and he gets 50%, and this is 50,000. That's 50% of the total, which is 100,000. All right. Total product cost for E then, 733,325, and for the T was 556,300. And the total then was 1,289,625. And then the cost not assigned to products. First we have our selling, and then we an admin. So I'll just SG&A. And only 400,000 of that was not assigned, because 150,000 was advertising that we assigned. And then other, which was that 60,375 of manufacturing overhead that under the ABC system was unallocated. So the total cost would be the 1,289,625 plus 400,000 plus 63,75. It's still the same total costs as under the traditional system. 1,750,000, 1,750,000. Our sales were 1,700,000, so we have a $50,000 loss. That still hasn't changed. It's just what I wanted to illustrate with this were these percentages. Under the traditional system, since it takes the manufacturing overhead and allocates it to the product, to the cost objects using one cost driver, it gave 74% of the overhead to the E product and 26% of the overhead to the T product. Now we know that this overhead, some of the cost of this overhead can be broken down by activities, namely the cost of the machining activity, the cost of the setups activity, and the cost of the product sustaining activity. What the traditional system is doing is it is implicitly saying that 74% of the cost of any of those activities should go to the E product, and 26% of the cost of any of those activities should go to the T product. Is that assumption right? For machining, it's not right. Only 59% should go to the E product, not 74%. For the setups, definitely not right. Only 20% of the setups cost, of the cost of the setups activity should go to the E product, not 74%, as the absorption costing system implicitly assumes. And then under the product sustaining, again, only 50% should go to the E, not 74%. So the traditional system is overcosting the E product. And in the same way, it's undercosting the T product. And that's the source of the difference, along with the advertising here. So there's two sources of the difference here in this particular problem. The activities, the traditional system implicitly assuming that the cost of the activity is 74% of any of the activities, whichever the activity is. 74% of the cost of that activity should go to the E, and 26% should go to the T, when in fact, really, the percentages are like this: 59, 41, 20, 80, and 50, 50. So that's one source of difference. And the other source is the traditional system just treats this advertising as a period expense. It doesn't allocate it. But the ABC system does allocate the advertising, and in fact it allocates twice as much advertising to the T product than it does to the E product. So the T product should get 100,000 of this cost. Under the traditional system it doesn't. And so these two reasons combined are making it appear that both products are profitable for the company to produce, and still they're having a loss, and so they can't explain it. So hopefully you can see why the ABC system was developed, and how in particular instances such as this one, how it could help the company figure out which product is actually profitable for them and which one isn't. This concludes the video on ABC.